Hello everyone, we're thrilled to welcome you back to our channel, where we explore smart investing strategies to help us build wealth over time. Today, we're diving into an exciting topic: cash-secured puts. This strategy allows us to get paid while waiting to buy stocks we already want to own. If you've ever wished for a way to earn income while holding out for a great entry price on a stock, this approach might become your new favorite tool. We'll break it down step by step in a conversational and educational way, ensuring that both beginners and experienced investors can follow along. Let's start with the basics to ensure we're all on the same page. Options are contracts that grant us the right, but not the obligation, to buy or sell a stock at a specific price within a set time frame. There are two main types of options: calls and puts. A call option gives us the right to buy a stock, while a put option gives us the right to sell it. However, we don't always have to buy these options. Instead, we can sell them, which is often referred to as writing the option. When we sell an option, we collect a premium immediately, which is like getting paid for taking on a commitment. Now, let's focus on put options specifically. When we buy a put, we're betting that the stock price will decline, allowing us to sell shares at a higher strike price than the market value. In a cash-secured put strategy, however, we're the ones selling the put. This means someone else pays us the premium for the right to sell us the stock at the strike price we've agreed upon. The cash-secured part indicates that we have enough cash set aside in our account to purchase the shares if the option is exercised. Typically, one contract represents 100 shares, so if the strike price is $50, we need $5,000 ready to cover the purchase. Why would we use this strategy? Imagine we really like a particular stock and want to buy it, but only if it drops to a price we're comfortable with. Instead of placing a limit order and waiting, we can sell a put at our desired strike price. We collect the premium up front, which reduces our effective cost if we end up buying the stock. It's like getting paid for our patience. If the stock price stays above the strike price at expiration, the put expires worthless, and we keep the entire premium as profit. If the stock price falls below the strike, we buy the shares at the strike price minus the premium, which could result in a better deal than the current market price. Let's illustrate this with a simple example. Suppose a stock is trading at $55 and we believe it has strong long-term potential. We decide to sell a cash-secured put with a $50 strike price that expires in 1 month, collecting $2 per share in premium, which equals $200 for one contract. If the stock closes above $50 at expiration, we keep the $200 premium with no further obligation. This represents a 4% return on the $5,000 we set aside, achieved in just 1 month. If the stock falls to $48, the put is assigned, and we buy 100 shares at $50 each. After subtracting the $2 premium, our net cost is $48 per share, aligning with the current market price, but we earned income while waiting. No investing strategy is without risk, and we need to address this up front. The primary risk with cash-secured puts is that the stock price could drop significantly below the strike price, leaving us owning shares at a higher effective price than the market. However, since we only use this strategy on stocks we're happy to own long-term, this scenario is more like buying at a discount with the premium as a cushion. Compared to purchasing the stock outright, we start with income in our pocket, which reduces our risk. Time plays a significant role in this strategy, particularly through a concept called Theta Decay. Theta Decay refers to how options lose value as they approach their expiration date. When we sell puts, time works in our favor because this decay benefits us. The premium we collect includes time value, which erodes daily, especially in the final weeks before expiration. If the stock price doesn't move significantly against us, we benefit from this natural erosion, increasing the likelihood that the option expires worthless. Volatility is another critical factor. Higher volatility leads to larger premiums because options prices increase when market uncertainty is high. We might target periods of market turbulence to sell puts and collect higher premiums. However, high volatility also means larger potential price swings, so we balance this by choosing out-of-the-money puts, those with strike prices below the current stock price, to provide some buffer. Selecting the right strike price and expiration date is essential. We typically choose strike prices where we'd be excited to own the stock, often 5 to 10% below the current price for a conservative approach. For expiration dates, shorter terms like 30, 45 days work well because Theta Decay accelerates near the end, but longer expirations might offer higher premiums if we're willing to wait. Our choices depend on our risk tolerance and market outlook. Let's compare this strategy to a traditional limit order. If we place a limit buy order at $50 for a stock trading at $55, we wait and hope the price drops, but we earn nothing in the meantime. By selling a put instead, we generate income while waiting. If the stock never reaches our target price, we still profit from the premium. We can actively manage these positions rather than just waiting for expiration. If the stock price rises and the put's value decreases, we might buy it back early to lock in a profit and free up our cash. If the stock moves against us, we could roll the put by buying it back and selling a new one with a later expiration or lower strike price, collecting additional premium and adjusting our position. Rolling doesn't always guarantee a profit, but it can help manage potential losses. Taxes are another consideration. Premiums from expired puts are treated as short-term capital gains, taxed as ordinary income. If we're assigned shares, the premium reduces our cost basis in the stock, affecting future gains or losses. Consulting a tax professional is wise, but understanding these basics helps us plan effectively. Cash-secured puts can fit into a broader strategy called the wheel strategy. In this approach, we sell puts to acquire stock, then sell covered calls on those shares to generate more income, repeating the cycle. Let's dive deeper into volatility's role. Implied volatility, or IV, reflects the market's expectation of future price movements. When IV is high, premiums are more substantial, but if IV decreases after we sell, we gain additional profit from Vega, which measures an option sensitivity to volatility. We monitor IV rank or percentile to time our entries, aiming to sell when volatility is elevated compared to historical levels. If you're finding this breakdown valuable and it's helping you understand how to use cash-secured puts in your investing, please hit that like button to support the channel. Also, consider subscribing so we can continue exploring strategies like this together. Position sizing is crucial for managing risk. We never risk more than 1 to 2% of our portfolio per trade to avoid significant losses if the market moves against us. Diversifying across different sectors also helps spread our risk. Market conditions influence our approach. In bullish markets, out-of-the-money puts perform well because assignment risk is lower. In bearish markets, we might choose deeper out-of-the-money strikes or pause the strategy altogether. We always align our trades with our broader market perspective. Here's another example to solidify the concept. Suppose a stock trades at $100 and we sell a $90 strike put for a $3 premium. Our break-even price is $87. If the stock expires above $90, we earn a 3.3% return on the $9,000 cash secured, achieved in a short period. If assigned at $90, our net cost is $87 per share. If the stock drops to $85, we're down $2 per share, but own a stock we wanted, cushioned by the premium. Let's revisit the risks. One risk is the opportunity cost of tying up cash, which might prevent us from pursuing other investments. Another is a sharp stock price drop due to unexpected news, leading to larger losses. To mitigate these, we focus on stable, high-quality stocks with strong fundamentals. For a more advanced perspective, delta helps us gauge the probability of assignment. A put with a 0.20 delta has roughly a 20% chance of finishing in the money. We use this metric to assess and manage our risk. Dividends are worth mentioning. If we're assigned shares before the ex-dividend date, we might receive dividends, but selling puts doesn't entitle us to them unless we own the stock. Brokerage requirements are straightforward. We need options approval, typically level 2 for selling puts, but cash-secured puts are considered safer than naked puts because we have the cash to cover the purchase. This strategy suits various investors, especially those seeking income, like retirees or anyone looking to build stock positions gradually while earning premiums. Let's address common mistakes. One is selling puts on stocks we wouldn't hold long-term, as chasing high premiums can lead to regret if assigned. Another is ignoring events like earnings reports, which can cause volatility spikes and hurt our position if negative news emerges. Over-leveraging is another pitfall. Selling too many puts can strain our cash reserves if the market drops and multiple contracts are assigned. Psychologically, we must be prepared for assignment. It's not a failure. It's simply acquiring the stock at a discount, aligned with our original plan. To build a routine, we scan for stocks we like, check their implied volatility, and select strike prices offering a good yield, calculated as the premium divided by the cash required. Aiming for 1 to 2% monthly returns is a reasonable target. Compared to other strategies, cash-secured puts are safer than naked puts because we eliminate margin risk. They're also more conservative than buying calls for speculative upside. In low-interest rate environments, this strategy can outperform bonds for yield while offering potential equity growth. Globally, cash-secured puts work in any market, but we must consider currency risk for international stocks. In summary, cash-secured puts allow us to earn income while waiting to buy stocks we want at a discount. With discipline and careful selection, this strategy can be a powerful tool in our investing arsenal. We'd love to hear from you. Have you tried cash-secured puts, or is something holding you back from giving them a shot? Drop your thoughts in the comments below, and let's keep the conversation going.